8,000. It's all coming just one day after the Fed announced it will raise interest rates by 1/4 of a point. You get bank stocks. They are also trending higher right now. Gosh, they've been up ever since the news of Donald Trump being elected. J.P. Morgan, Bank of America, Goldman Sachs, Citi, Wells Fargo. Take a look at that green all across the screen right now. So financials really helping to lead the Dow higher. What does it all mean for investors as we head into the new year? I got a couple of differing strategies here. Joining me right now, Pelosky Global Strategies founder Jay Pelosky, along with BMO Private Bank CIO Jack Ablin. Good to see both you guys. All right, Jay, you've been expressing some concern right now. Walk us through your fears. We're watching, for example, the 10-year, the 30-year bond move higher in its rate, and the concern I think you have is that that's actually going to really start to hinder the market at some point. Explain your thesis.
Sure, Trish, and I think that's exactly right. Look, yesterday the Fed surprised the market with its suggestion that it's going to raise rates 3 times next year. The market was prepared for 2. So you see the dollar strengthen, you saw stocks sell off, you saw bonds sell off. Tough to make money in the stock market or in financial assets when stocks and bonds both sell off at the same time. And so I think,
but you know, the market's still higher right now. I mean, it's been pretty good.
It's not higher than where it was right after the news yesterday, right? We had a big sell-off yesterday. We've clawed some of that back. But look, I think the point is quite simple. It's really the battle of the Trump stimulus plan versus inflation fears and the bond vigilantes. If the bond vigilantes drive rates up, then I think it's very difficult to see the stock market do well. I think you see a stronger dollar, and the combination of a stronger dollar and higher interest rates aren't good for either stocks or the economy.
Okay, so Jack, I'd like to get your reaction. I mean, he's making the point here that basically the cost of money is going to go up. It's going to cost more for you to buy that new house. It's going to cost more for a CEO to borrow money to build the new plant. You know, and that is the reality of higher interest rates. You're also going to be dealing with the higher dollar, which means it costs more for foreigners to buy our goods, so maybe they don't buy as many. The flip side of that, and the hope, of course, is that the stimulus, the less regulation, the lower taxes, all that is enough to really expand the economy. Where do you come out on it?
Yeah, I think the key is really what the Fed does ultimately. I think the investors are shrugging off the 3 hikes. I think this is very similar to kind of the boy who cried wolf last year when they claimed that they were going to do 4 in 2016. We had the sell-off, and eventually they backed off to 1. So I think that there is a bit of skepticism. I do think the Fed is so fearful of deflation that they're willing to let inflation run a little bit higher, a little bit stronger, knowing that they have a 35-year track record of keeping inflation under control. So
I mean, it's easier, right? Just to jump in for the viewer, it's way easier to deal with an inflationary economy than to deal with a deflationary economy.
That's it. I mean, you know, we've talked about pushing on a string, but essentially the Fed has got their, you know, their party hats on, their pom-poms, their cheerleader outfits on over the last few years, and they couldn't get people to borrow and spend. So now with you've got full employment, you're throwing in nearly $500 billion of proposed stimulus. You roll back regulations, you roll back taxes. I don't know if all that stuff's going to go through. But I think this is probably one of the best things that the Fed could encounter.
Well, I mean, hey, this is good news, right? For Janet Yellen. She's been going it alone for years now, and she's had no help from the federal government. So you want fiscal and monetary policy working together, but, you know, we've basically only had monetary. Jay, it's got to be a good thing that there's a shot at some fiscal policy for a change.
Well, I think that's right, Trish. And remember, I wrote the piece called Waiting for Fiscal back in the spring, arguing for fiscal stimulus. Yes, that's a good thing. But I think it's a narrow policy path between too much fiscal stimulus, too much tax cuts, too much debt, and therefore the bond vigilantes, not the Fed. I agree with the other guest that the Fed is going to probably slow walk rate hikes. I think the fear is that the bond vigilantes, the investors themselves, get anxious and get worried and sell off the bond market, and that hits the rest of the stock market.
I wrote about bond market vigilantes, and you know, the last time we saw them was 1993. So we now have a global glut of capital floating around the world. My sense is it's going to wash up on our shores and likely keep interest rates lower, maybe dollar stronger, but interest rates lower than it would ordinarily be.
I like that scenario. Fingers crossed it happens, Jack. Thank you so much. Are we going to see 20,000 before year end, Jack?
Coin flip.
All right.
Yeah, sure.
I should think we would. I should think. We are just points away. Thank you so much, guys. Good to see you. All right.